Top down, the big features of the week are going to be the inflation figures that are due out from the UK on Tuesday the 13th of February and then America on Valentine's Day, Wednesday the 14th. In the UK, inflation finally stops accelerating in December, helped by the stronger pound, so it'll be interesting to see how these trends played out in January. Remember that in the prior round of figures, inflation in the UK was 3% according to the Consumer Price Index, 2.9% according to the Office of National Statistics preferred CPIH benchmark, which takes into account housing costs for owner-occupiers, and 4.1% according to the Retail Price Index, or RPI. In America, headline inflation on the Consumer Price Index, CPI, was just 2.1% in December. But note how the New York Fed's underlying inflation gauge puts it at 3%, and that chimes a bit better with the latest American wage growth numbers that showed a rise of 2.9%. All of those figures basically have got stock and bond markets sweating over whether the new chair of the US Federal Reserve, Jay Powell, will find himself having to raise interest rates more quickly than thought. Current consensus is for 3 1/4 point hikes this year, with the first one coming in March, and in total those 3 would take the headline Fed funds rate to 2.25% by December. Bottom up, we've just 3 FTSE 100 firms due to report figures in the week ahead, although there's a good smattering of comment due from FTSE 250 firms too. Notable scheduled announcements include those due from former FTSE 100 member Dechra Pharmaceuticals on Monday the 12th, FTSE 250 gold miner Acacia on the 13th, Coca-Cola Hellenic Bottling Company, which releases full year results on the 14th, former FTSE 100 healthcare player Convatec and software specialist Aviva on the 15th, and finally, real estate investment trust Segro on Friday the 16th. But for me, the company really capable of causing a fuss in the week ahead is biopharmaceutical giant Shire, which is due to release its 4th quarter results on Wednesday the 14th of February. As we can see here, the shares have been shocking performers over the last 2 years, tumbling from the £50 region to barely £33, even as the FTSE 100 itself has made gains to broadly all-time highs during that period. 2 issues in particular have weighed on the stock. One is debt. Shire bought Baxalta in 2016 for $32 billion in a cash and stock deal that added to its portfolio of treatments of rare diseases but also added to its borrowings. The other is competition, as Shire's haemophilia business in particular faces a powerful new rival in the form of Hemlibra, an injection developed by Switzerland's Roche, while its ulcerative colitis treatment, Lialda, now faces competition from a rival Indian drug which received regulatory clearance last year. In addition, boss Flemming Ornskov cut the company's 2020 sales target back in January from $20 billion to between 17 and 18 billion, although to try and sweeten that bitter pill, he also said he was looking at splitting Shire into 2 parts, rare diseases and neuroscience. The former represents about 70% of the business, the latter about 30%. An update on this plan isn't likely alongside the full year results, as further details aren't due until the second half of the year, although do note that a US-based activist hedge fund, Sachem Head, has been pressing for spin-offs and asset sales, and it's not clear whether Shire's plan goes far enough to keep it happy. When it comes to the 4th quarter report, analysts will be looking at 3 things from a strategic perspective. An update on the clinical pipeline, where Shire has 40 drugs in development, including 17 at the phase 3 stage, the release of ongoing cost benefits from the Baxalta deal, and then the debt pile. It reached over $22 billion on a net basis in 2016 after the acquisition, but analysts are looking for this to have dropped to around $19.5 billion in 2017 and then to keep going lower. In terms of the numbers, well, the consensus forecasts are as follows for 2017 and also 2018, with any forward guidance in mind from Chief Executive Ornskov. For 2017, analysts are looking for sales of around $15.3 billion, rising to $16 billion in 2018. For 2017, analysts are looking for operating profit of $6 billion against $4.4 billion last year, with that stepping up to $6.8 billion in 2018. Now, those are adjusted figures, the company's preferred measure, as it excludes restructuring costs, amortization of goodwill associated with acquisitions. This final graphic shows the gap between reported and adjusted operating profit. Now, not everyone likes to see such a big gap between statutory figures and the company's preferred adjusted earnings before bad stuff measure, and it's to be hoped that the gap will close as Baxalta is digested and the restructuring process comes to an end. Thank you for watching, and I look forward to seeing you next time.